This Faith and Finance podcast is underwritten in part by Christian Healthcare Ministries. Are you finding it increasingly challenging to find affordable healthcare? Christian Healthcare Ministries is a budget-friendly, biblical, and compassionate healthcare cost-sharing alternative that aligns with your Christian values. And it's available in all 50 states and around the world. Learn more at chministries.org/faithby.
Hey, open enrollment ends in just a few days. Have you decided on a new health insurance plan yet? Hi, I'm Rob West. Maybe you don't have to. What if there was another way, a biblical solution for meeting your healthcare costs? Well, there is, and I'll talk about that first today. Then it's on to your calls at 800-525-7000. That's 800-525-7000. This is Faith and Finance, biblical wisdom for your financial decisions. So what exactly am I talking about? Well, it's medical cost sharing, an alternative to insurance that can save you hundreds of dollars every month. You might say it's based on the principle found in Galatians 6:2, bear one another's burdens and so fulfill the law of Christ. In fact, that verse is the scriptural foundation for Christian Healthcare Ministries, an underwriter of this program, and the oldest organization in the medical cost-sharing space. They've been helping believers share the financial burden of healthcare since 1981 and have made it possible for members to share nearly $11 billion in medical costs. So how is this approach different from health insurance? Well, for starters, instead of paying premiums, members contribute a monthly share amount based on the plan they choose. That turns out to be a lot less expensive because CHM members are considered self-pay by their healthcare providers. That means the cost of those services is a lot less than if they were covered by insurance. Members are then reimbursed from the share pool for covered costs. For instance, while health insurance premiums in the Affordable Care Act marketplace may be comparable due to premium tax credits, the out-of-pocket costs are often significantly higher than those with CHM due to extremely high deductibles and out-of-pocket maximums. However, with CHM, the highest annual personal responsibility cost is $6,000 per person under their bronze plan, giving you a potentially lower cost alternative that won't break your monthly budget. Health insurance companies operate with a business model that prioritizes financial sustainability, often including shareholder obligations. In contrast, a nonprofit medical sharing organization focuses solely on its members. Without the need to allocate funds for shareholder dividends, these organizations can direct more resources toward member needs, helping to keep costs low and making healthcare more accessible. Now, one of the ways insurers try to keep costs down is by making agreements with healthcare providers. Those agreements result in so-called coverage networks that then limit your choices. If you receive medical services outside the network, the insurance company could decline to pay. So you're on your own if your favorite doctor or facility is outside the network. But that's never a problem with medical cost sharing. There are no networks. Members can see any medical provider they wish, in any facility they wish. As long as the service is covered in the plan, and most are, they'll be reimbursed for the cost. Medical cost sharing is also portable. Members don't have to be stuck in a job they don't like just to get health insurance. Their CHM membership goes with them if they get a new job. The same is true if they want to start their own business. They don't lose coverage by leaving their job. Another major difference between Christian Healthcare Ministries and a health insurance company is that you join an entire community of fellow believers united by their faith in Christ. Members pray for each other. Often, CHM's customer support reps pray with members who call in with medical problems. Those words of encouragement and compassion are priceless benefits. Now, I don't want to sound mean-spirited about health insurance companies. They can be a real blessing, especially for catastrophic illnesses. But they also have become huge bureaucracies that are bogged down even further by government regulation, and that's unfortunate. Medical cost sharing avoids most of those problems because it's not insurance. Christian Healthcare Ministries has much lower overhead than a typical insurance company, which keeps costs to members low. Members also have more control over their healthcare decisions. With no insurance company in the middle, they can work directly with medical providers to set up treatment plans and payments. When an organization is committed to biblical stewardship, generosity, and sharing the love of Christ in practical ways, it's really worth checking out. CHM offers a biblical solution to healthcare costs. By the way, if you signed up for health insurance in 2025, but now want to try medical cost sharing instead, you can probably still cancel that insurance without penalty. To find out a lot more, just head to chministries.org. All right, your calls are next. 800-525-7000. We'll be right back.
Are you searching for a way to become a better, faithful steward of the resources that God has given you? Well, download the FaithFi app and join the 37,000 others who are already using our app. The FaithFi app will provide you with wisdom, community, and simply help you stay on track with your finances. We have 3 money management options to choose from, so find an option that fits your unique needs. It's available on desktop or mobile. Simply go to faithfi.com and click App to get started.
Frustrated by your health insurance? Confused by the network restrictions and increasing premiums? There's a better way. Christian Healthcare Ministries. CHM is a Christian community delivering a faith-based solution to the high cost of healthcare. Take back control of your healthcare with the ability to choose a provider you trust with no network restrictions and savings of up to 40%. Learn more and enroll today at chministries.org/faithfi. That's chministries.org/faithfi.
Great to have you with us today on Faith and Finance. It's time to turn the corner and take your calls and questions today. We've got lines open. If you have a question, give us a call. 800-525-7000. That's 800-525-7000. We'd love to hear from you. Let's go to Chicago. Allison, how can we help?
Hi. My husband and I are purchasing term life insurance, and the question has come up, do we make each other the primary beneficiary with our children as the contingent beneficiaries? We have a blended family, and 3 of our kids are already grown, 2 of them married. 3 of them are still in the house. They're getting ready to launch into the world. They're teenagers, so...
Yes. All right. Yeah. So I think the first thing you need to do is just kind of work through your estate plans with a blended family. It's a little more complicated, but I think the goal is, of course, unity and oneness as husband and wife, and then praying through what God has entrusted to you so you can decide how much you want to leave to your children and how much you want to leave to ministry or charity. There's only 3 places we can leave money: to the government, we want to minimize that, to our heirs, and to ministry or charity. And so deciding how you want to approach that, especially with kids from a previous marriage, I think that can take a little extra time and attention to kind of sort through all of that. And then once you have that plan in place, then we put all the necessary planning tools in place. So you would certainly want a will, especially with minor children at home, because that's going to name your guardian, but it's going to be kind of the catch-all for making sure what God has entrusted to you, personal assets and furniture and financial assets and real estate and otherwise, is passed according to your wishes. And then the beneficiary designation, whether it's on an IRA, a 401k, or a life insurance policy, is also going to designate where certain types of accounts, including term life insurance, will go, at your death. And that happens outside of probate and goes directly to those heirs. So have you all decided exactly how you want everything distributed at your death, if, let's say, you were to pass away at the same time?
Well, so we're trying to work through that right now. Our term life insurance is, our 15-year term life insurance is getting ready to expire. And so the decisions we made 15 years ago was my husband made me the beneficiary. And then for some reason, we had a much smaller policy on me that named the children. And I don't really recall why we did it that way. And so now we're thinking that each of us should be the primary for the purpose of maintaining the same lifestyle that we have for the kids that are in the house.
Yeah.
And so it got a little bit confusing because we are kind of on a timeline to get this done, and we realize we can change it afterwards, but we kind of want to complete this process. We're also in the process of trying to get all of our stuff together for an attorney for the will, and so it's just kind of all culminating. But the life insurance thing, we kind of want to get taken care of this month so we don't have a period of time where we're uninsured.
Yes. Yeah, that makes sense. Well, I think the key is, typically what folks will do is make each other as husband and wife the primary beneficiary on everything. And so that way, regardless of who predeceases the other, the remaining assets for you all as a couple, one flesh, are then with the other spouse to be able to maintain the lifestyle, provide for the kids and your spouse and so forth. And then you would have a plan in your will or perhaps in a trust, to handle everything else. One option is if you did a revocable trust, you could have as the contingent beneficiary on all these accounts, including your term life insurance, the trust named, and then that way the trust managed by the trustee could then house all of the assets at your death, and then they could be distributed based on your wishes. So, you could have them paid out to the kids as they reach certain ages. You could have the expenses of the children, especially the minor children, paid for out of the trust. And then eventually at certain triggering points or events, the assets could be distributed, to your kids as heirs. But all of that could be controlled through the trust beyond your life. Apart from that, you would just name the kids as contingent beneficiaries. And then let's say you and your husband passed away at the same time, then everything would go straight to the kids. And if you had minor kids, they would be held in custody and managed by, whoever is named as guardian at that point. So I think you've got a couple of options there, but typically I would make your spouse the primary and then perhaps either the kids or a revocable trust if you decided to go that direction as the contingent.
And so let's say that I died and then so my husband receives the whole thing, then that's done with, correct? It's not like if it doesn't carry on after that. Does the whole thing just go to him right then?
Yes.
Or is there
with a beneficiary designation?
Well, so if he's 100% and I die, then he would get it. But if he died a year later, that's just a separate issue,
It is, because that policy would be closed. The death benefit would be paid out to him, and then he would be free to do with that what he wants. And then that's where his own estate planning at that point would kick in terms of how he wants to handle it passing at his death. And so if you wanted to set that up to be able to determine, assets that you had, prior to marriage or life insurance that you have on your life that's intended for your children because of your blended family, that's where you would want to, of course, talk through that with your husband and make sure you all are on the same page and really good communication and driving toward unity. But to the extent you all came to a decision that you wanted to handle certain assets differently for the benefit of your children that perhaps you had prior to marrying one another, then that's where a trust would come into place, because you would not have certain assets paid directly to your husband. They might go into the trust for the benefit of your kids.
Okay. And it doesn't matter if they're adults.
It does not matter if they're adults. It really comes down to how you want to distribute them, and that's really something you and he need to work through to make that decision. We appreciate your call today. Thanks for being on the program, Allison. All the best to you. Let's go to Indiana. Hi, Sandy. Go ahead.
Hi. I want some information on savings bonds. I have been to my bank and I have called my credit union, and neither one deals in savings bonds. I've got a grandson who's turning 1, and I thought that might be a good birthday present for him for the future, but I don't know where to go. I don't know what to do.
Yeah, it's a great question. And really, you almost can't get them anymore. Now, some banks, if you're an existing customer and you have a paper bond, they will redeem it, but not all of them will, because everything is moved online. And so the way you would purchase a savings bond is on the web at treasurydirect.gov. treasurydirect.gov. And that's the place where you would buy the U.S. savings bonds. You'd open an account there. You could make your son the beneficiary. It could even be a custodial account, or your grandson. You could purchase them there, and then you would always be able to check the value of them on that website because they would be electronic. There's no more paper bonds, really. Now, I will say they're not as attractive as they used to be, just because the rates are lower and you can do better elsewhere. So let me throw out two other ideas. One would be a 529 account, which is essentially a college savings account. And if you want to learn more about those, you could go to savingforcollege.com. And you could set up an automatic amount you put in every month, or a one-time amount, and then it could be invested and grow. The second is you could just buy a good high-quality mutual fund, like maybe one of the faith-based investing funds at our website, faithfi.com, in a separate account, and then just keep it for him and give it to him down the road. Thanks for your call. We'll be right back.
As the leading advocate for the Christian financial industry, Kingdom Advisors serves the public by promoting the integration of a biblical worldview across every aspect of the financial services industry. And we serve a growing network of thousands of Christian financial professionals, equipping and empowering them to carry biblical financial wisdom to their clients, peers, and community. For more information, visit kingdomadvisors.com. That's kingdomadvisors.com.
Faith and Finance is grateful for support from Sound Mind Investing. For more than 30 years, they've offered financial wisdom for living well. SMI provides step-by-step guidance for do-it-yourself investors, from those just getting started to those getting ready for retirement. More information, including a short video webinar on profit and peace of mind no matter what's happening in the market, is available at soundmindinvesting.org.
Thanks for joining us today on Faith and Finance. I'm Rob West. We're so glad you're along with us today. Let's tackle a couple of emails. This first question comes to us by way of Hannah. She writes, "We recently sold our house for a good profit, and we're wondering how to tithe on it. Do we tithe on the full amount we received, or only what goes above the initial price and interest we paid?" You would tithe on the difference between the sale price, Hannah, and the initial purchase price. So you don't have to look at anything else other than what is that true increase in the value of the property, because when we're giving a tithe, it is based on the increase, the profit. So no matter what asset it is, whether it's a stock or a piece of real estate, it's simply the difference between the sale price and the original purchase price. That increase, then you would apply a 10% tithe and then give that to your local church. I think that's a great idea. This next one comes to us from Karen. She writes, "I have a 401k and I'm wondering how I can invest according to my values with the options that are available in it. It seems like the only options are big companies that I'd rather not be invested in. Do you have any suggestions?" Well, yeah, if you don't find one of the faith-based investing fund families in your 401k now, and there's a good chance you won't, I would contact your 401k custodian and tell them that you're interested in values-aligned investing and that you'd like to suggest the addition of some of these fund families like Praxis, like Timothy Plan, like Eventide, like One Ascent or Guidestone. It may not happen right away, but as they start to hear from more and more of their 401k account holders, they're eventually going to add those. And they're always reevaluating what new funds need to be in the plan. So just because they're not in there now doesn't mean they won't be in there next year. And so I would reach out first. Second, you can also see if you have something called a brokerage window. That's just simply the opportunity for you to invest beyond the menu of choices in your 401k in anything that's available through that custodian. And odds are, if it's a Fidelity or Schwab or one of the big brokerage firms, you'd be able to get access to one of the faith-based investing companies. The third option, just put enough in your 401k to get the match and then put the rest up to the annual contribution limit in a Roth IRA or a traditional IRA, and then you most certainly could invest in the faith-based investing fund families when you do that. All right, let's get to one more here. Maria says, we want to give our daughter $500 to invest so that it can grow for when she buys a house later in life. Should we put it in an IRA, a CD, savings bond, or something else? It really depends on the time horizon. If you have at least 10 years, I'd put it in a mutual fund, just a stock fund that would allow it to grow over time. If not, I think a CD would be a great option. Thanks for writing to us. By the way, folks, if you have a question, send it along. AskRob@faithfi.com. Let's go back to the phone. Chicago's where we're headed next. Bernie, go ahead.
Oh, thank you, Rob. I love your show. Thanks for taking my call.
Thank you.
The question is, I was thinking of buying these two single-family homes. They're both $250,000 each. I have property that's worth 7 or 8. What is the implications if I want to sell a multi-level and buy homes? Is there something I need to know other than the standard, closing costs and all that? The multi is a mortgage-free. So nothing owed on it.
Okay, yeah. Well, you can do a 1031 exchange, which is also known as a like-kind exchange, and you can exchange an apartment building for rental single-family homes because both types of property qualify as like-kind under the IRS Section Code 1031. So it defines that term like kind pretty broadly, and that's why both of those, because they're used for investment or business purposes as opposed to personal use, can be factored into the 1031 exchange. So that just simply means you'd be able to sell the apartment building so long as you followed the timing of identifying the next properties within 45 days, closing on them within 180 days. You essentially kick the can down the road with respect to the capital gains tax on that multifamily property, which is a good thing because you don't have to pay that now. You could pay it later and get full use of this money moving forward. I think the key would just be that you find those properties that make sense, don't get over levered, because we don't want you to be in a situation where, let's say the economy were to take a pretty significant downturn and you went for a longer period of time than you expected without a renter. I just don't want you to put yourself in a difficult spot. But assuming you go in with enough equity, you can take advantage of the 1031. You clearly are going to have those costs on the sale of the property, and so you need to factor that in because that's going to come out of the proceeds of the sale. But assuming you account for all of that and you like the idea of switching the multifamily for the multiple single families, then it certainly can be done.
Thank you so much. I appreciate you taking my time to answer my question. Thank you so much.
All right. God bless you, Bernie. Thanks for calling today. Let's finish up in Pennsylvania today. Hi, Corey. Go ahead.
Hi, Rob. Thank you so much. I'll be brief.
Sure.
I have a car that I bought years ago. I still owe on it about $5,500. Minimum payment is $185 a month. However, it's starting to nickel and dime me on the cost of maintenance. The bank owns the title. What are my options?
What is the car worth?
A little less than what's left on the loan, probably about $4,000.
Yeah. Well, I mean, the best option is you sell it as a private sale and pay off the loan, and then you'd have to come out of pocket for the difference. But you try to maximize and get as much value out of it as you can by selling it yourself, and get as close to that, $5,500 as you can, and try to, spend as little as possible on the difference. The other option is if you're wanting to buy another car, you could try to roll this into that deal essentially where, you would trade this car in and, again, you're going to have to come out of pocket. And I guess the challenge is, you will have to, well, let me back up. The dealership may not give you as much as you would get from a private sale, and so you may end up having to pay more towards satisfying that loan. But at the end of the day, we need to make sure that that loan gets paid in full because, you have that obligation. And so that's why trying to maximize the sale and then turning around and buying something you can afford, is the best path forward. Does that make sense?
Yes. Last question. The car itself is the collateral on the loan, so I don't own the title. So I don't think selling it personally would be an option because I don't own the title. Is that?
No, it would be. I mean, you can do a private sale even with a loan on the car, and they're just going to need to be paid in full before they release that title. But you certainly can sell it as long as, you are able to cover the difference between what's owed and what you sell it for, because, when you pay off the loan, that's what's going to release that title, and then you can transfer it to the other party.
Okay, thank you so much.
Yep. All right, you're welcome, Corey. Thanks for your call today. Well, that's going to do it for us today. A big thanks to my team today. So thankful for our call screener today, as well as Dan and Amy and Jim. Couldn't do them without them. Hope you'll come back and join us next time, and we'll do it all over again. Until then, God bless you. Bye-bye.
Faith and Finance is provided by FaithFi and listeners like you.